record this too as well. All right. So let's continue with our auctions. We don't need to. All right. Some of the requirements. Yes, I just started recording it. So it will be available. I'll share it with you guys. So let's see here. Some of the requirements when we are buying, when we are getting ready to buy a house, and some of these could take a long time. Not long time, but we need to start thinking about it. So when you're buying a house, a initial deposit is required, depending on how big the house is, how much the house costs. Option money, tell you the truth, I have to go back and see what that is, but down payment is something we'll get into more. Down payment is something that is required for us, the cash that we are putting in here. As we mentioned, there are fees that we need to pay for buying a house. There are closing fees, we'll get into more to that. And then whenever we buy a house, we are required to pay some of the fees, the taxes and insurance prepaid, because particularly taxes are assessed and due at certain times of year. They are due in December, and then they're again due in April. So if you buy a house in June, we are required to pay the taxes from the time we buy until the next assessment when it's being done, whether it's being December or in April. When we are buying a home, usually an inspection is recommended. If you're buying cash, it's really up to us if you want the inspection. But then when we are getting a loan, definitely the lender is requiring an inspection and also an appraisal, as we will see. As far as closing costs go, most often we need to find a lender. We'll look at how we find lenders and how do we look for them. But some of the fees that they charge, point is usually a percentage of the loan. So if you're getting a $300,000 loan, a point is considered $3,000. 2 points will be considered $6,000. One of the very first things that they do when we apply for a mortgage is they look at our credit report. Not just the credit score, but mortgage is one of those that they go deep into our credit report. When we apply for a credit card online, the system often is, and we get an immediate approval or decline. It is the system just looking at the credit score. But for mortgages, for business loans, the credit report is really being looked at to see what's happening in here. Again, lenders require an appraisal, a professional to come in, and they look at the house, they look at its condition. They also compare it with the homes that have been sold in that area within the last 6 months or so. That's how they come up with a value for the house. Then there are a bunch of other fees that they just keep adding on. There's fees on tax, tax on fees, insurance on tax. It's really crazy. There's so many of them. These are just a few that I've listed in here, but don't be surprised if there are fees. I remember one time we were selling a house and they wanted a certificate of not having a wood burning fireplace. It was crazy. It's like, I don't have it. Why do you need a certificate? I don't have a proof. Do you need a certificate for that too? So just be prepared. We can try these. A lot of these are negotiable with the lender particularly. Some are not. But they can be negotiated with the lender before even getting into. You can even fix and say, I'm willing to pay this much. And that's you figure out how you want to break out these fees. Escrow, as we will see, is a account. It's usually a bank account that's offered by an independent company for all the money to come in and all the money to be dispersed. So when everything is done and you're ready to take ownership of a house, a date is set as when the ownership is transferred from the old owner to the new owner. And you cannot just go in there with a personal check. All the money that's coming from the new mortgage company, from your deposit, from everything else is coming into that on that day. And then the money is leaving, the old mortgage is being paid off. If there's any surplus, goes to the old owner. Escrow is being paid. So there's a lot of transactions that's happening on the day of the sales happen and the house is recorded. These are some of the other fees in here. Title fees are anytime a property is being exchanged in hand, the new lender, or even if there is no lender, we want to make sure that there is no lien on the house. And a lien is basically whenever we do not pay, we owe money to anyone, anyone can put a lien on our property. So for example, our house, a contractor comes in, works on the roof, we owe them $5,000, or there's a dispute over that $5,000, that contractor, the roofer, can go to the county and put a lien on our house until that dispute is settled. Either we pay him or we leave it, and it will stay in there. If we don't pay it, it will stay in there until the house is being sold. So that's why this title search and title insurance and recording fee is listed as one of the fees in there. Yeah, there's a lot of information in here. I'll share everything with you guys, so you can look at it later. Let me see, what do we have? All right. So the home buying process. We can either start by looking at the house, so we can do them simultaneously. Obviously, we want to start looking at the homes, but then also we want to make sure our finances are in order. There are certain things that we do, like we start having a saving for the down payment, for the deposit, make sure that we can afford it. Pre-qualifications is one of the greatest things that we can do. We can always talk to a mortgage broker that we've selected and give them all of our information. Except just be careful, you don't necessarily have to give your social security number, because as soon as you do that, they will run your credit. And that would be, if you remember from our credit session, that would be counted as one inquiry, as a hard inquiry. But most of the, if you find a good mortgage broker, they can very much give you a ballpark figure of, if you have $10,000, this is your income, and these are the expenses, this is the neighborhood that you're looking at, how much money you can borrow. So that's a soft qualification. Once you are ready, you are serious, then you can actually ask for an official pre-qualification letter, which at that point, it's okay to give your social security number, let them run your credit, so they can, because without running your credit, they cannot give you a letter of intent that we are willing to give you this much money with a certain interest rate. So we talked about cash requirements, what you need to have, shopping around. So shopping around is definitely for a home, for your real estate agent, and also for your mortgage broker. And we'll see why that is important. So we talked about the pre-approval, write-in an offer. That is something that you will be doing once you like a house. You will write an offer with your real estate agent. In there, these are the things that are set in. What is the purchase price? Oh, the option money is, I remember what it is. Often when you purchase a house, because the seller wants to make sure you are serious, let's say if they ask you for $10,000 in deposit, they will put it in there that you have maybe 1 week or 2 weeks, whatever you agree on, that's the period you can do your due diligence. Do the inspection, run the appraisal, and all of that to make sure that you can afford. If at that time, if you pass that period, which is, let's say, for 2 weeks, if you pass that period, then the seller says, well, either you have to buy this, or if you back out, I will not give you a deposit back. The earnest money that, or deposit, will not give back. So those are all the things that go into the agreement. So when you're writing an offer, please make sure you read everything. And if you don't understand it, ask your real estate agent. If he or she does not provide you with a satisfactory answer, definitely ask someone. You can always ask other people. Closing date is set. It does spells out the seller's and buyer's responsibility, which is a lot. Preparing, and then seller has to do a lot of disclosures. Anything that has happened in the house, if someone has died in the house, not of natural causes, but anything that has happened, if there was a major repair in the house, hurricane went through it, all of those has to be disclosed. And then also there are contingencies that both sides can put in. Exactly. So the buyer says, I can only buy this if I qualify or if I get a loan. And if I cannot get that loan, then the seller has to release your earnest or deposit money. There's a lot of documents that could be requested going back and forth, particularly from the seller to the buyer, to make sure you can ask for utilities, you can ask for tax bills, everything that is reasonable, it can be asked for. The negotiation, usually I don't know why, but I don't know why two people or the seller and the buyer cannot just sit in the room and do their negotiations. Usually they love to just go back and forth on paper. I do understand some of it has to be written down, but that's how it used to be. I have not done a transaction in house for a long time, so maybe now everything is electronic. We talked about the due diligence process, ordering and reviewing the inspection report, reviewing the site survey. Site survey is to make sure that your property is where it's supposed to be. So every property has its outline and its boundaries recorded in the county. Sometimes owners may move their fence just a little to the left or a little to the right. Those are things that show up on site survey. Your property line is always recorded by a nail in the sidewalk in front of the house. So as next time when you're walking around in the neighborhoods where there are houses, look on the sidewalk, you see a nail in there, and that's right in the middle of the two homes. Reviewing the seller's disclosure, make sure I understand what you're getting into. Final agreement throughout the process of negotiating, your purchase agreement could be changed depending on what's happening in there. Often when the inspection comes back, the inspector finds things that may need to be fixed or things that may not. They're just kind of like, okay, it's broken. This outlet does not work. And it's up to you and the seller to come to an agreement of what needs to be fixed and what can wait. Obviously, if there's termite damage, that has to be fixed. If the house is tilted or it's sinking, then those are cause for concern. But if the fence is falling off, then that's something that you will consider that. As we're getting close to the end of this module, please put up any question or just open your mic. I mean, there are only a few of us here today, so you can definitely open your mic if you have any questions. Financing and closing, as we talked about, there is a date set for everything to be recorded and closed, and the key is being exchanged in hand. Hazard insurance, that is something that needs to happen. The lender always requires the insurance to be effective on the day when the closing is happening, not a week after, because it's a huge investment. A $300,000 loan, the lender wants to make sure if tomorrow there's a fire, they're covered and they're not going to lose everything. All right, so I'm going to switch over to the mortgage and stuff. If you have any questions, again, put it up. Open your mic. All right. So loans and mortgages, we're going to be concentrating on mortgages. So mortgages are basically loans that are obtained for a house. That's why they're called mortgage. Why borrow? Because we're making an investment. The house is considered an investment if we buy it in the right time, particularly when we buy for our residence. When we're buying as an investment, timing could be a little bit more. You have to look at the timing, but anytime we're buying for our personal residence, because we're going to be living in there for a long time, it's definitely not that any time is a good time, but at least it's a better time generally. Who should borrow? Again, it's your responsibility first and foremost to make sure that you are a responsible borrower. The banks do their due diligence, but overall, it's you. And again, if you remember from 2004 to 2008, that banks have gotten so greedy that they were just lending anybody any amount of money, whether they could afford it or not. That was totally irresponsible of both sides, both the banks, the mortgage agents, which were getting a lot of kickbacks. We'll see what that is, all the way to the people who thought that they were going to buy a house and they will become rich in 6 months, because some had actually done that, but we knew that it wasn't going to last. So ultimately, we need to do independent investigation of what is right for us. How much should I borrow? That again is really up to you based on your finances, what you think. A bank never knows when you're going to change your job or what's going to happen to you. Now, of course, a lot of things are out of control. Nobody was expecting coronavirus to happen, so nobody could predict that. But we know often that where our life and our financial life is going. And that's why we were putting so much emphasis on the budget sheet and income and expense tracking, because that gives us a fairly good indication of what we have and what we don't have. How much can we borrow? How much can we pay for a house? To borrow and invest first, I'm going to skip that one. We don't have to worry about it. Okay, so loans, we're concentrating on mortgages. Let's skip those. How much can I afford to borrow? We talked a little bit about that. Let me get to the mortgages. Calculating the loan amount. I do have the spreadsheet. I will get to that one. I want to really get to the mortgages. All right. So there are a lot of terminologies that go with mortgage. I know, Nathan, you asked about APR in one of these sessions. So APR has, while it stands for annual percentage rate, but it does have a different meaning when you're putting money into a savings account as opposed to when you're getting a mortgage. They serve different meanings in there, which will go in there. We talked about cash reserve that we need to have. Conforming and jumbo loans every year based on the area that we live. I think it's a federal guideline that they put certain limits of how much is considered a conforming loan, which is the lower amount, I believe, don't quote me, but I think right now in California, or in Southern California, it is $510,000. So any loan under the $510,000 is considered a confirming loan. And jumbo loan, I don't know what the limit is, but I think it's about 750 or so. Then it becomes a jumbo loan. Why is that? Why is there a difference? The rates are different. The qualifications are a little different. Obviously, people who are buying their first home, most often they do confirming because they can also get better rates. If you are a veteran, if you are involved with military, there are specific mortgages for our service members. For those who are starting, FHA loans, which we'll talk more down here, Federal Housing Administration, they are better loans for first-time home buyers because they have lower rates, they have easier qualification process, but that is, again, only for the first time when we buy a house. After the first time, we do not qualify for an FHA. And then the conventional loan is what's considered as the non-governmental loan that you get from a bank, from a credit union, or from other sources that we see a lot of it on TV these days, advertising a lot of loans. So these loans, so any property that has 1 to 4 units is considered a residential property. So whether you buy a single family home or you buy a fourplex, it is considered a single family loan. The loan is considered a single family, and the rate is lower than once we start getting into the 5 unit and above. 5 units and above, that becomes a commercial property, and the rules are a little different in there. We talked about the federal FHA loans. All right, so now we're getting into some of the terminologies of when we are getting a loan. So usually when you approach a mortgage broker, and again, please make sure that you select a reputable mortgage broker that your friends, your family, others have worked with. They know they're honest, because there are a few, unfortunately, there are still a few crooks out there that try to take advantage of people because they are looking at their bottom line. And the reason for having a mortgage broker, so let's look at it this way. You can walk into any bank and start talking to them directly. For example, you can walk into Chase Bank. They have someone who is specialized in mortgages. But then the challenge with that is that they only have access to their own loan products, which are a lot of different products. They will not resell loans from Bank of America, from Wells Fargo, or from any other sources. So that is the challenge when you go directly to a lender. When we work with mortgage brokers, they have access to a larger pool of lenders, which a lot of them we don't even know. There are a lot of small banks or a lot of small lenders that do offer mortgages that banks don't do. So that's why it's always, and not every agent has access to everything. Now, again, you don't want to go to 5 different agents or 5 different banks and give them your social security number so they run your credit. You want to kind of do your investigation and due diligence a little bit beforehand. Now, going back to our credit session, I believe these days, any credit inquiry that happens on your credit report and it's from a mortgage company within a 30-day period, it's considered as one because they know that you are looking for buying a house, and that is okay. However, remember, if you go and apply for 5 different credit cards, whether you get all 5 of them or none of them, that is 5 individual card inquiries on your credit report that you definitely don't want. So be very careful of that. So GFE, or good faith estimate, when you work with either a banker or a mortgage broker, they will give you an itemized estimate of what the expenses are going to be. Whether you have selected property, so they know exactly what the purchase price is, your down payment, all the taxes and fees that are listed in there. But it is said a good faith estimate because they're not the final numbers. Certain things will stay the same, but certain things will change. But it should be within depending on size of the house that you're purchasing, it should be within the estimate. And you can always go back and ask them, say, why is this higher? Why is this lower? What would happen in there? Some of the lenders require you to have an impound account, which means that they want, as part of your monthly mortgage payments, they want you to pay them for the insurance and for taxes. The reason for that is that they don't necessarily trust the homeowner to have to keep the money around to pay the lump sum when it comes. Insurance is usually once a year, or it can be paid monthly. And remember, taxes are paid twice a year, in December and in April. So it is very possible that the lender requires you to pay the impound. Sometimes they offer interest on it. If they do, it's very low, and sometimes they don't. So it's really up to them whether they want to impose this fee. It's not a fee, it's an account. Loan to value, this is something that's of great importance. So whenever you are trying to get a mortgage, the lenders have different guidelines of how much money they are willing to lend you based on 2 factors. How much you can afford per month, and then what is that in comparison to the purchase of the house that you're willing to purchase, the purchase price. The main guideline is that they prefer you to have at least 20% of the purchase in down payment. That is the preferred. That is when you're getting the best loan, the best interest rate, the easiest way. So 20% down payment from you, and then 80% loan. Now, I'm sure you have seen some agents or some banks, they offer 10% down payment, 5% down payment, 3% down payment. All of those are possible, but in reality, you're actually getting 2 loans, one for 20% and then the other one for the remaining, even though it may not seem as 2 loans, but that's how it works. And then the main loan, the 80% loan, would usually have a lower interest rate, and then the difference. So if you're putting only 5% down, and we'll look at it on a sheet based on numbers, and you're putting a 5% down, so your first loan is for 80%, and then the second loan is for 15%, which will have a higher interest. Often, that higher interest may come as this one, MIP, mortgage insurance premium, or there's another terminology, private mortgage insurance. Those 2 could be in place of your second loan in there. They could be put in there with that. We talked about pre-approved. It's a good idea when you're ready to get pre-approved. Some mortgages have prepayment penalty. So basically they say if you pay the loan off, if you sell the house or you refinance the loan within the first 5 years, there is some fees in there. That's not too common in residential. It is very common in commercial properties. Pre-qualifications we talked about, PMI we talked about. All right. The rate. When you're shopping for mortgage rates, you see on TV, or I'm sure you see on social media, you see so many different rates in there. Right now, a lot of them are offering like 2.25% for a 15-year loan or 2.75%. Interest rates on a mortgage is unfortunately something that's not, there are no apple-to-apple comparisons. There are so many variables in there that affects the rate that you're being offered. So what's been advertised often is not what you're going to get. And it's not that they're trying to deceive you. They are advertising the lowest possible rate, which you have to kind of line up the moon and the sun and a few other stars. Now, again, they're not lying, but they are advertising the lowest available rate in here. So if a mortgage is being advertised at 2.5%, that is the rate. And to answer Nathan's question of what is the difference between rate and APR, the APR is actually, I'm going to back up here, the APR is calculated, the rate, the percentage, and the percentage of fees that you're going to pay for that loan. The reason that has been put in place is for the borrowers to have a fairly good understanding just by looking at two numbers. So when you're looking at two different loans, one says, both of them say interest rate is 2.5, and then their APR, one says 2.75, and then the other one says 3%. That means that the second one is going to have a higher fees right at the beginning. What fees are those include? There's a lot of calculations. It's very detailed that goes in there. But that is kind of a way, and as you will see next time, we're not going to banks anymore, but when you see the advertisement, look at, you see the rate, and then the APR is always a little higher, or it could be the same. If it's the same, that means that the lender is not charging any fees. Now, that doesn't mean that there are no fees for recording the title, all the other fees that we talked about, the inspection, the appraisal. Appraisal is usually part of the borrowing. So that kind of gives you a good percentage. Let's see. There are different types of ratio. One general rule is that the lenders are looking at, or you can even look at it yourself. They want to make sure that your monthly mortgage payments are not more than 29, let's say 30% of your income before taxes. So, for example, they can look at your pay stub. Your pay stub, your gross is $3,000. So based on that, the quick calculation is that your monthly mortgage payment in interest and principal cannot be more than $1,000 a month. Now, what does that mean in how much you can borrow? We'll see that in the spreadsheet. Based on that, they can calculate how much money they can loan you, and then based on that, you can see how much house you can afford and how much you can buy. All the loans have terms, how long it's going to take to pay them. We'll see that. You do have the right of refusal. Anytime you get a mortgage, you can definitely refuse it within 72 hours to cancel that. We talked about the veterans, truth in lending. That's a statement that is just a general statement that all banks have to provide about their APR and percentages and bits. Okay. And again, if you have any question, I know I'm doing all the talking. If you have any questions, just pop it up there. So there are many different types of mortgage types, which we have to select. And that's part of the reason that makes comparing mortgages not apple to apple. It's apple to orange to banana to peach. There's so many different types that what we have to see is like which one is right for us. Most of the mortgages amortize over 30 years. So when they say that your monthly mortgage payment is $2,000 a month, that means that for the next 30 years, the bank is expecting you to pay that $2,000. Now, the rate could be different at times. It could adjust. It could be a lot of different things that can be happening to it. It could be fixed for 30 years. It could be fixed for 5, 7, 10 years. So there's a lot of different options in there. Balloon mortgages, I don't think they exist that much. There are some that when you get a mortgage, they'll tell you that in 10 years you have to pay this off. You have to refinance, which doesn't happen that often. The fixed rate mortgages are principal and interest that will stay the same for the duration of the loan or whatever that is. Interest only mortgages, this was very popular during the real estate crash, that because people thought that price of the homes will continue to go up, lenders to bring the payments down would only require the lenders to pay only the mortgage. I'm sorry, only the interest, no principal. And then worse than that, there were the neg am mortgages that was really a killer that got a lot of people into trouble. Again, people's greed felt that if I buy a house for $300,000 and I keep it for 1 year, or often in the new developments, they would go put their name on a house. And in the 6 months before that, when the house was ready, they were able to sell it for a higher price. So a lot of people thought that the prices would go higher and higher. So banks, what they started offering was that, all right, your interest on the loan is, regular interest is 5%, but right now, because we know that the prices are going to go up, there's going to be equity in the house, we are only asking you to pay 2.5% of the interest every month. And the other 2.5% will be added on to the principal. And that's what got a lot of people into so much trouble. That's what happened in there. Let's see, no doc. All right. Now we're getting into some of the documentation that the banks are going to require you to show. Banks' favorite type of loans is full stated income. That is when we are employed. At least one person is employed and receiving a W-2. It doesn't matter how much. They just like to see that somebody has a stable job because they can count on that payment to be paid on time. Then there are other types of loans that usually charge a higher interest rate for those that cannot produce a document. For example, these days, if a person or there's a couple that only does Uber, that could be something for them. So there are a lot of different ones. And there are some that usually in the state of income, they want to see 2 years of tax return. They want to see your pay stubs, your W-2, your bank statements. So there's a lot of documents that needs to be prepared when you're applying for a loan. I'm going to skip the biweekly plan, HELOC. Let's not worry about that one, because I want to show you the sheet before we run out of time. So any question, please put it up. Let me know what it is. I know it's a lot of information that we're presenting in here, and I want to make sure that you do ask any questions that you have. So we talked about some of the things about location, community taxes, and so forth. We talked about mortgage types, fixed. So these are fixed terms. Usually you can get a mortgage that you're expected to pay off either in 30, 20, or 15 years. There's no mortgage that you're expected to pay it off in 5 years. That just doesn't make sense. But then within these 30, 20, 15 years, there could be variable rates. There could be loans that your rate is fixed for 30 years. Those usually have the higher rates because lenders don't know what's going to happen in 30 years. And usually nobody lives in the house for 30 years. We're almost getting there. We've been in this house for 22 years now. But then within that 30 years, you can have variable rates. So you could say that, oh, I want the rate to be fixed once for the first year. And then after that, it will start to adjust once a year. Or I can do 3 years of fixed rate. The lower the number of variable rate year is, the lower the interest rate is going to be. So let's say for 1 year, it could be 2, for 3 years, it's 2.25, and so forth, and it goes up until we get to the 3% that will have a higher interest rate. So for example, right now these days, again, if you want to get a purchase, it would, for 15 years, they're advertising 2.25. For 30 years, they're advertising 2.5, a little higher. Again, most of the loans are amortized over 30 years. We talked about APR and so forth. Down payment, we talked about principal and interest. These are terms that we talked about. I want to get into an example that we have here. So you can see some numbers, and I'll share this with you guys. All right. So let's say in San Diego, we are looking at a simple single-family home. Will run you probably at least $500,000. We can start with a, let's start with a good percentage. So let's say if we can come up with $100,000, that is the ideal point where we have come up with 20% in down payment, and we're going to do the first loan as 80%. Now, if I go back to 50,000, you see that now the 80%, the first loan stays at 80%, and then now there is a second loan for the missing 10%. Or if I go 25, let's just keep it at that. Okay, so you're putting $50,000 down. That's your down payment. Remember the LTV, or loan to value. So now they're saying that loan to value is 90%. It's higher than the 80. So it will take a little longer for the lenders to approve you. The term is 30 years. We are looking at a 3% for the first loan. 4% is a little too high. So let's say 3.25. Let's bring that a little lower. So the second loan will be at a little higher rate. And this is what we're looking at. So this sheet, and once I'll put this sheet in your workbooks, you can play with these numbers, and it will update all the numbers automatically. So based on all these numbers, our monthly principal and interest is $1,900. That means that over every year, we'll be paying about $23,000. And over the life of the loan at 30 years, we'll be paying $700,000. So we're buying a house for $500,000, but we'll be paying $700,000. Now we've done a little comparison of that. We'll do that to if we do a rental, let's say thing. Real estate taxes. Tax is very much fixed. Is at 1.25% of the purchase price, which is $500 a month. But that's for the year. If you're buying a condo, most likely there's an HOA that you have to consider. HOAs could get expensive, $300, $400, depending on where it is. And then the insurance, I'm just using $1,000 figure in here. So we're looking at a monthly of $2,500. One of the things that lenders always want to see before they give you a loan is that they want to make sure that you have at least 3 months of your payments in an account. It does not have to be a liquid account, like it does not have to be cash. It can be your retirement account. That is absolutely acceptable because they know that worst comes to worst, you can't access it. But that money, the reserve, has to be somewhere under your name, and it has to be there before you start applying for a loan. You cannot just go deposit money into your bank account while you are in the process, because they'll ask, where did this money come from? And you cannot say, I just borrowed it from my friends. They will go as far as asking your friends to provide a bank statement. When did you transfer? What is the agreement? They really go into those details. But what I wanted to see is that over 30 years, that $2,500 a month becomes $1 million. So this would be the cost of owning this home without any maintenance, anything else. If you compare that with a rental for $3,000 at $4,000 a month, that would be $1.5 million almost. So you can definitely see the saving. We're not even considering the appreciation that the house will. Okay, so we're looking at the mortgage rule of thumb as we talked about. So this $2,500, that translates to you needing, so that's the 28%, the DTI, debt to income ratio. So when you're purchasing a house, that's why they want to see your credit report. They want to see what other obligations do you have on your credit. They just do not take our words for it. They see what is our student loan, credit cards, auto, if you have a judgment, anything that will be counted in here. And the maximum that's allowed or they will consider is 8%. So they're saying that your home mortgage and insurance and tax should stay under the 28%. Your debt should stay around 8% for a total of 36. So that is talking about $3,200. Now that $3,200 translates to, that is what our monthly obligation is going to be between our debt and the house. So multiplying that by about 3, we get $9,000 a month. So we need to have $9,000 in gross income, not net. This is before taxes. That's what they look at, your income, whether it's from your W-2, whether it's from your 1099, whether it's from your business, from Uber, whatever. That is what the general rule of thumb is that we're looking at here. I want to stop here. We don't need to go into the equity. We got only a few minutes left, and I have to jump another meeting. I want to open it up. Any questions, guys? You guys have been so quiet. And open your mic. Ask any questions. Again, I will share this worksheet with you, and I will either add it to the online worksheet that you have, or those that don't have it, I'll somehow get it to you. I'll create a separate one and send it to you. Any question, guys? You've been so quiet. Nathan, you're always chatting in the chat. Okay. Well, if there's no question, I'd like to end it here. Thank you so much for coming and participating. And that will conclude our lesson for today. I know it was a lot of information, but hopefully you can always go back and I will share the recording with you.
Thanks, Alex. It was great. Very informative.
You're welcome.
Thank you.
All right, no problem. See you guys later.
Bye.
Bye.